Picture your grandfather sitting at the kitchen table in 1987, a stack of IRS forms in front of him, a cup of coffee going cold. He knew something that most people today have completely forgotten. He knew exactly where the line was. He knew what the government could take, and he knew what they could not touch. That knowledge was worth thousands of dollars a year, and somewhere between then and now, it got lost. Today we are drawing that line again, because it never went away. They count on you not knowing. That stops today. Here is the context you need before we go through the list. Most of these protections were written into law decades ago, some as far back as 1954 when Congress overhauled the entire Internal Revenue Code. Others came in waves: the 1983 Social Security Amendments, the 1990s Taxpayer Bill of Rights reforms, the 1998 introduction of Roth IRAs, and the 2006 creation of Qualified Charitable Distributions. The rules are still there. The dollar amounts have been updated. What has not been updated is how many Americans over 65 actually know they exist. Number 1. The IRS cannot tax your Social Security benefits if your provisional income falls below the threshold. For a single filer, if your provisional income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefit, comes in under $25,000, 0% of your Social Security is taxable. For married filing jointly, that threshold is $32,000. The rule is written down. Most people just never read that far. And here is the part that will make you angry. Those thresholds were set in 1983 and have never once been adjusted for inflation. Think about what it means that those thresholds were frozen in 1983 dollars. In 1983, a retiree earning $25,000 in provisional income was considered relatively well off. Today, that same $25,000 is a modest fixed income. Congress designed this tax to hit higher-income retirees, not middle-class seniors living on a pension and a modest savings account. The IRS did not move those goalposts. Congress left them where they stood 42 years ago. That is not a technicality. That is the law as written, and it affects millions of people who were never supposed to be caught by it. Number 2. The IRS cannot tax your Medicare benefits. Not Part A. Not Part B. Not most of the Part D subsidies. Not Medicare Advantage payments made on your behalf. IRS Publication 554 states it plainly: Medicare benefits received under Title 18 of the Social Security Act are not includable in the gross income of the individuals for whom they are paid. That is the government's own publication telling you that these benefits are off the table. Many seniors assume every federal payment that touches their life is taxable income. This one is not, and the law draws a firm, clear line. Number 3. The IRS cannot tax a qualified charitable distribution from your traditional IRA, even when that distribution is satisfying your required minimum distribution for the year. Once you reach age 70 and a half, you can direct money straight from your IRA custodian to a qualifying charity. That amount is excluded from your income entirely. It counts toward your RMD, but it does not show up as taxable income on your 1040. Starting in tax year 2025, the IRS introduced a new code, Code Y in Box 7 of your 1099-R, specifically to flag these distributions so they are not accidentally reported as taxable. Here is a detail on QCDs that most tax preparers miss. If your 1099-R was miscoded and the QCD amount was reported as ordinary taxable income, you have the legal right to file an amended return within 3 years of the original filing date and recover that tax. The IRS must honor the exclusion when the paperwork is done correctly. The money went directly from custodian to charity, it never touched your hands, and the law says it is not your income. If a preparer made that mistake on your return in 2024 or 2025, you still have time to go back and fix it. It is already yours. You just have not claimed it yet. Number 4. The IRS cannot tax qualified Roth IRA withdrawals once you have met the 5-year holding rule and you are at least 59 and a half years old. Those distributions are completely excluded from your income. They do not appear as taxable income on your 1040. But here is the strategic layer that most people miss entirely. Roth withdrawals also do not count toward your provisional income calculation for Social Security. That means pulling money from a Roth instead of a traditional IRA can keep your provisional income below the $25,000 or $32,000 threshold and protect your Social Security from being taxed at all. Number 5. The IRS cannot deny you the enhanced standard deduction that kicks in at age 65. This is not a new benefit. Seniors have received an additional standard deduction bump for being 65 or older for decades, and the IRS instructions in Publication 554 spell out the exact dollar amounts by filing status every single year. But starting in 2025, Congress added a significantly larger enhanced deduction on top of that existing bump. Some analyses put the additional amount at up to $6,000 per person over 65, or $12,000 for a married couple where both spouses are 65 or older, phased out at higher income levels and in effect through 2028. To put the size of that missed deduction in plain terms, ARP has noted that missing the age 65 standard deduction bump can cost a single filer roughly $8,000 in lost deductions in a given year, and a couple where both spouses are 65 or older as much as $15,200, depending on the specific year and the applicable law. That is not a rounding error. That is a real dollar difference in what you owe, and the IRS cannot deny it to you if you qualify. The only way you lose it is by not claiming it, because nobody told you it was there. Number 6. The IRS cannot force you to file a federal return if your income falls below the legal filing threshold for seniors. These thresholds are higher than what most people assume, and they got significantly higher starting in 2025 with the enhanced senior deduction factored in. A single filer over 65 has no filing obligation if their non-exempt income, excluding Social Security, is under $17,750 under the standard rules, or up to $23,750 with the new senior bonus applied. For a married couple filing jointly where one spouse is over 65, the threshold rises to $33,100, or $39,100 with the bonus. And for a married couple filing jointly where both spouses are 65 or older, the no filing threshold reaches $34,700 under standard rules, or $46,700 when the enhanced senior deduction is included. These are legal filing thresholds, not suggestions. If your income is clearly below them, and you have no self-employment income or special tax situations, the IRS cannot demand a return from you. Many seniors file out of habit, which is fine, but understanding this threshold means you also know when you are legally in the clear and when the IRS has no claim on your time or paperwork. Number 7. The IRS cannot count your Social Security benefit itself toward those basic filing thresholds. This is a point that trips people up constantly. The filing threshold amounts we just covered are calculated on income excluding Social Security benefits. Social Security is handled under its own separate inclusion rules based on provisional income, which we covered in point 1. The IRS cannot treat your Social Security check as ordinary income for the purpose of deciding whether you are required to file at all. These are two separate legal calculations, and conflating them is a mistake that costs seniors money every single year. Number 8. The IRS cannot chase a tax debt forever. Under Internal Revenue Code Section 6502, the IRS has a hard 10-year statute of limitations from the date of assessment to collect a tax debt. That deadline is called the Collection Statute Expiration Date, or CCD, and when that clock runs out, the debt becomes legally uncollectible. They cannot levy your bank account for it. They cannot garnish your income for it. They cannot seize property for it. Your grandfather's accountant knew this rule by heart. It is still the law today, and it is one of the most powerful protections in the code. An important note on the 10-year CCD: certain actions can pause or extend that clock. Filing for bankruptcy, entering an installment agreement, submitting an offer in compromise, and a few other actions can toll the statute, meaning the clock stops running during those periods. But the IRS cannot unilaterally extend it indefinitely on their own say-so. There are strict rules about what pauses the clock and for how long. If you have an old tax debt and you are not sure where the QCD stands, that is one specific question worth asking a tax professional, because once that date passes, the law is on your side completely. Number 9. The IRS cannot levy your property without first sending you specific written notices and giving you the right to appeal. Under Internal Revenue Code Section 6330, before any levy can proceed, the IRS is required to issue a notice of intent to levy and notice of your right to a hearing. When you receive that notice, you have a 30-day window to request a collection due process hearing with the IRS Office of Appeals. During that entire period, and until the hearing is resolved, the IRS generally cannot move forward with the levy. This is not a courtesy. This is a statutory right. It applies to every taxpayer regardless of age. Number 10. The IRS cannot seize your primary residence casually or on the authority of a single low-level revenue officer. Seizing a principal residence is one of the most restricted actions in the entire Internal Revenue Code. It requires court approval. It requires sign-off at high levels within the IRS. Agents cannot simply file an administrative levy and take your home the way they can move against a bank account. The law requires written notice, multiple due process steps, and strict procedural compliance before a residence seizure can legally proceed. Your home is not the same as a checking account in the eyes of the tax code. Number 11. The IRS cannot revoke your passport for a tax debt, and it cannot do so immediately or without a process. Since 2018, the law allows the IRS to certify a seriously delinquent tax debt to the State Department, which can then restrict or revoke your passport. But the threshold for that certification is significant, roughly $59,000 to $62,000 in total delinquent tax debt, adjusted for inflation each year. And the IRS cannot revoke the passport directly. It can only certify the debt to state. There are statutory exceptions and opportunities to resolve the debt or appeal before any passport action takes place. Number 12. The IRS cannot garnish an unlimited portion of your Social Security or wages. Federal law places specific limits on wage garnishment, and the IRS must follow standardized levy tables that protect a portion of your income. For Social Security, federal law under 42 U.S.C. Section 407 protects those benefits from most creditors entirely. Even when the IRS does have the authority to levy Social Security for a tax debt, the standard rule is a 15% levy, not a full seizure of your benefit. You keep 85% of each payment, while any levy is in effect, and you still have the notice and appeal rights recovered before any of that begins. Number 13. The IRS cannot assess additional tax against you without giving you formal notice and a right to challenge it. If the IRS runs your return through its automated matching systems and finds a discrepancy with a W-2 or a 1099, it must send you a notice of deficiency before it can officially assess additional tax if you disagree. That notice is sometimes called a 90-day letter, because you have 90 days from the date of the notice to petition the United States Tax Court to challenge the assessment. The IRS cannot skip this step. It cannot go straight to enforced collection on a deficiency you have never been formally told about. Number 14. The IRS cannot ignore the Taxpayer Bill of Rights. Congress formally embedded these 10 rights into law, and IRS employees are required to operate within them. The rights include the right to be informed, the right to quality service, the right to pay no more than the correct amount of tax, the right to challenge the IRS's position and be heard, and the right to appeal an IRS decision in an independent forum. The IRS formally adopted the Taxpayer Bill of Rights in 2015, but many of the underlying statutory protections had been in place for years before that. These are not suggestions. They are operational constraints on every IRS employee you will ever deal with. Number 15. The IRS cannot deny the additional standard deduction for being 65 or older, even if you do not itemize a single expense. This is separate from the larger enhanced deduction we discussed in point 5. Every taxpayer who reaches age 65 by the last day of the tax year gets an automatic additional standard deduction amount on top of the regular standard deduction. Add legal blindness and you get another bump on top of that. The IRS Instructions and Publication 554 publish the exact dollar amounts each year by filing status. If your tax preparer is not applying this automatically, that is an error, and it is correctable going back 3 years. Number 16. The IRS cannot deny you married filing jointly status simply because you are over 65. Filing status rules are completely age-neutral on this point. Being 65 or older does not disqualify you from the most favorable joint filing status if you meet the standard marital and residency requirements. And that matters enormously, because married filing jointly gives you a larger standard deduction, wider tax brackets, and more favorable treatment across dozens of provisions in the code. A younger spouse does not drag you into a worse filing status. If you are legally married and living together, the joint return is yours to claim. Number 17. The IRS cannot tax veterans' disability compensation. Federal law excludes VA disability benefits from gross income entirely. For an older veteran who is drawing Social Security, a pension, and VA disability compensation at the same time, this distinction is significant. Many veterans assume that because their Social Security may be partially taxable, everything coming from a federal source must be taxable. That is not true. VA disability compensation is specifically excluded. The IRS cannot include it in your income, cannot use it to push your provisional income over the Social Security threshold, and cannot treat it as ordinary income on your return. Number 18. The IRS cannot treat qualified long-term care insurance benefits as fully taxable income. Under Internal Revenue Code Section 7702B, benefits received from a qualified long-term care insurance policy are generally excluded from income up to daily and annual caps set in the code. Older Americans are the primary users of these policies, and many do not realize that the benefits coming in are not taxable income up to those statutory limits. If your policy qualifies under the code, those exclusions apply automatically. The IRS must honor them. If your preparer is including those benefits as income without checking whether the policy is qualified, that is worth a second look. Number 19. The IRS cannot retroactively increase the tax rate on income you already earned and reported under the law that was in effect for that year. Article 1 of the Constitution gives Congress, not the IRS, the power to lay and collect taxes. When Congress changes rates or brackets, it does so for a defined tax year going forward. The IRS cannot decide on its own that last year's income now falls under a new rate table. It must apply the law as enacted for the year in which the income was earned. This protection is foundational. It means the rules you filed under are the rules that govern that return, period. Number 20. The IRS cannot cancel cost of living adjustments that Congress has written into the law. Many thresholds in the tax code are indexed to inflation by statute. The seriously delinquent debt threshold for passport certification, IRA contribution limits, and various other figures are adjusted annually by law. The IRS publishes the updated numbers each year, but it cannot choose to skip an adjustment that the code requires. This is why the $59,000 to $62,000 passport threshold we discussed in point 11 moves upward over time. Congress wrote the indexing into the law, and the IRS must follow it. The rule is written down. Most people just never read that far. Number 21. The IRS cannot reclassify your Social Security benefit payments as wages or self-employment income to hit you with payroll tax on the way out. Social Security benefits are defined separately under federal law. They are not subject to FICA taxation again when you receive them. Any portion of your benefits that does become taxable under the provisional income rules is treated as ordinary income, not as earned income for payroll tax purposes. You paid into the system your entire working life. The IRS cannot reach into your monthly benefit and take another round of payroll taxes out the other end. That door is closed by statute. Number 22. The IRS cannot override tax treaties that protect certain foreign pensions or foreign Social Security type payments for Americans living in the United States. For older immigrants who worked in another country before coming here, or for Americans who spent part of their career working abroad, U.S. tax treaties with specific countries control how those foreign government payments are taxed. The IRS must follow treaty provisions where they apply, It cannot override them with a general domestic policy. If you are receiving a pension from Germany, Canada, the United Kingdom, or another treaty country, the specific treaty language governs, and it may protect more of that income than you realize. Number 23. The IRS cannot levy certain categories of property that Internal Revenue Code Section 6334 specifically lists as exempt from levy. The list includes some personal effects, tools of trade, unemployment benefits, certain annuity and pension payments, workers' compensation, certain service-connected disability payments, and a minimum amount of wages or salary. These exemptions apply regardless of age, but older Americans who are living on fixed incomes and limited assets are often the most vulnerable when they do not know these items are protected. The IRS cannot take what the code says is off limits, and Section 6334 is very specific about what that means. Number 24. The IRS cannot treat a properly executed qualified charitable distribution as both satisfying your required minimum distribution and as taxable income at the same time. It is one or the other. If the distribution was sent directly from your IRA custodian to a qualifying charity, it counts toward your RMD for the year, and it is excluded from your gross income. The IRS cannot have it both ways. If your 1099-R was miscoded and shows that amount as taxable income, you have the legal right to correct it on an amended return. The exclusion is in the law. The IRS must honor it when the distribution was done correctly. Number 25. The IRS cannot tax the interest from qualifying municipal bonds as ordinary income. That interest is exempt from federal income tax by statute. However, and this is the nuance that trips people up, the IRS is permitted to count that tax-exempt municipal bond interest when calculating your provisional income for Social Security taxation purposes. So they can use the number in the formula, but they cannot tax the interest itself. The distinction matters because seniors who hold municipal bonds may find that their tax-exempt interest is quietly pushing their Social Security over the taxability threshold, even though the bond interest itself never gets taxed. Let us step back for a moment and look at the historical arc of all of this. In 1935, when Social Security was created, those benefits were completely tax-free. For almost 50 years, your grandparents' checks were untouched by the IRS. That changed in 1983 when Congress introduced the provisional income thresholds to tax up to 50% of benefits for higher earners. The $25,000 and $32,000 thresholds were designed to affect only the top 10% of Social Security recipients at the time. But because those thresholds were never indexed for inflation, they now catch a large portion of middle-class retirees who were never part of the original design. The 1990s brought a wave of collection protection reforms that gave taxpayers real procedural teeth. The collection due process hearing rights under IRC Section 6330, the strengthened notice of deficiency requirements, the formalization of levy exemptions under Section 6334, these were not accidents. They came out of congressional hearings where the IRS was found to have used aggressive and sometimes abusive collection tactics against ordinary Americans. The reforms that followed are why the IRS today must send formal notices, must allow hearings, and must follow a documented process before it can touch your property. Your grandfather's generation fought for those rules. They are still in force. The Roth IRA arrived in 1998, named after Senator William Roth of Delaware. It was a structural shift in how retirement savings could work. For the first time, Americans could put after-tax money into an account and never pay federal income tax on the growth or the qualified withdrawals. For seniors today, the Roth is not just a savings vehicle. It is a tax management tool. Because Roth withdrawals do not count as provisional income, they give you a lever to control how much of your Social Security gets taxed each year. That is a planning opportunity built directly into the law, and it has been sitting there since 1998. Qualified charitable distributions were introduced around 2006 as a temporary provision and were made permanent later. The idea was straightforward. If you are 70 and a half or older and you have a traditional IRA, you can satisfy your required minimum distribution by sending money directly to a charity, and that amount is excluded from your income. It does not push your provisional income up. It does not affect your Medicare premium calculations. It does not drag more of your Social Security into the taxable column. For seniors who are charitably inclined and have traditional IRA balances, this is one of the most efficient tools in the entire tax code. Now let us talk about what you can actually do with this information this week. Start with your most recent tax return. Look at line 6B on your Form 1040, which shows the taxable amount of your Social Security benefits. If that number is greater than 0, calculate your provisional income and verify that the taxable amount was computed correctly. Then check whether the age 65 additional standard deduction was applied. Look at the standard deduction line and compare it to the published amounts for your filing status and age. If you were 65 or older last year and that extra deduction is missing, that is an amended return waiting to happen. If you received IRA distributions last year and made charitable contributions, check whether a qualified charitable distribution was an option you missed. If your IRA custodian sent money directly to a qualifying charity and it was coded correctly on your 1099-R, verify that your preparer treated it as excluded from income rather than as ordinary taxable income. If it was reported as taxable when it should not have been, you have up to 3 years from the original filing date to amend that return and recover the tax. This is not a gray area. The exclusion is statutory. The IRS must honor it. You just have to know to ask. If you have received any IRS notices in the past several years, particularly anything referencing a levy, a deficiency, or a balance due, pull those letters out and look at the dates. Identify when the original assessment was made. Count forward 10 years. If the collection statute expiration date has passed or is approaching, that changes your options significantly. If you are currently in an installment agreement, or have submitted an offer in compromise, understand that those actions toll the statute. But if you have an old assessed debt with no active agreements, and the 10-year window has closed, the law may already be protecting you and you do not know it yet. If you are a veteran receiving VA disability compensation, confirm right now that your tax preparer is not including that amount in your gross income. Pull your most recent return and look at the income lines. VA disability compensation should not appear as taxable income anywhere on that return. If it does, that is an error. Similarly, if you hold a qualified long-term care insurance policy and received benefits last year, verify that those benefits were treated as excluded from income under IRC Section 7702B rather than reported as ordinary income. These are two categories where incorrect reporting is surprisingly common and entirely correctable. One more action item before we close. If you hold municipal bonds and you are receiving Social Security, run your provisional income calculation including the tax-exempt interest from those bonds. Remember that interest is not taxable as ordinary income, but it does count in the provisional income formula. Many seniors are surprised to find that their tax-exempt bond interest is the variable that pushes them over the $25,000 or $32,000 threshold and makes a portion of their Social Security taxable. Knowing that lets you make informed decisions about your portfolio mix going forward. This is not a loophole. This is the law. Your law. Understanding the formula is how you manage it. Here is what ties all 25 of these together. None of them are secrets. None of them are loopholes that clever lawyers invented. Every single one of them is written in the Internal Revenue Code, in IRS publications, in the United States Constitution, or in federal statute. Your grandfather's accountant knew most of them because they were taught as basic professional knowledge. What changed is not the law. What changed is who is paying attention. The IRS processes hundreds of millions of returns every year. It does not have the resources to correct every missed deduction or every wrongly included benefit on your behalf. That job falls to you, and now you have the list. The generation that built this country paid into this system for 30, 40, sometimes 50 years. They were not asking for anything extra. They were asking to receive what the law said they were owed. The protections we covered today were not handed down as favors. They were written into the code through decades of legislative work, court decisions, and in some cases, direct congressional pushback against IRS overreach. They belong to you. They have always belonged to you. The only thing standing between you and every dollar you are owed is knowing where to look. Now you know where to look. If this video gave you something concrete to act on, subscribe right now, because every video on this channel is built the same way: a specific, documented right or benefit, the exact law behind it, and what you can do about it this week. Hit the bell so you do not miss the next one. And if you know someone over 65 who has been leaving money on the table, share this video with them today. The next video in this series covers the Medicare billing rights that hospitals are legally required to give you before you ever see a bill, and most people never receive them. That one goes up next. Do not miss it.